Good evening. Welcome to episode 21, The Bulls Return. Good evening to you, Wawi.
Good evening, Mark.
Good evening. Good Saturday evening. And good evening to our listeners. I hope everyone had a great week so far. This is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wawi Show. A disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and to our co-workers in the medical field, thank you guys for your hard work. We are available in YouTube, Spotify, and Google Podcasts. On our previous episode, the 20th episode, we discussed the outflows in ARC, the debt ceiling, possible rising market volatility this coming December, the ever red hot real estate market, and a weekly discussion of flows and sentiments in the stock market. And there were a couple of rolling clips or video clips from the Bullish camp, which is Tom Lee from Fundstrat, and from the Bearish camp, or people who think that the market would go down, which is from Mike Wilson of Morgan Stanley. All right, going on to our episode. So we're gonna look at the sentiment flows and industry performance of the market so far this week and so far this year. So on our first slide here is the American Association of Individual Investors. So we check this on a weekly basis, compare the sentiment of the investors in the stock market. Bullish means people think that the stock market will go up in the next 6 months. Bearish means stock market will go down. So for the week ending in 10/13, which is a couple of days ago, bullish camp has risen. So like our title says, the bulls have returned. So compared to last week, we were under 30%. We were in fact the lowest in the past couple of months at 25.5%. But as of 10/13, we are hovering at 38%, a huge 13% jump. And meanwhile, the bearish camp, or those people who think that the market will drop, had lessened from 37% down to 32%, a 5 percentage point drop. While the neutral, or those who are 50-50, or playing it safe, had reduced from 37.7% to 30%, 30.3%. So more neutral people and more bearish people are joining the bullish camp as of this recent week. The fear and greed index has at least risen to 51 points. Now we're at neutral compared to last week's 34 points, which is fear. So these graphs are indicating that people are turning bullish. On the graph over time of the fear and greed index, we are close to hovering near 60 points, which we haven't touched since, I believe, late May or early June. And the volatility index, as what we have introduced to us back in our second episode, is down for the past 5 days, or for the past week alone. It's down 17 percentage points, quite a drop, indicating that the stock market may have at least increased during this week, which we will see in a little bit. So for the past month, the volatility, or the fear and greed, the fear index is down 22%. And for the past 6 months, as you can see here, it's trending downwards, but it's still within the range for the past 6 months. And for the past year, the volatility is in fact down 40%. So this kind of explains the fact that the market is ever been resilient to whatever news cycle the market brings. The debt ceiling as of recent, the oil hitting all-time highs, or not all-time highs, but 8-year highs or 7-year highs, inflation rate going hot, red hot. So regardless what the newsline or headlines say, market has been ever resilient. The fear and greed for the crypto market, it's now in its extreme greed. So last week it was at 71 points greed level, but as of today, It's in extreme greed. For those who don't trade the crypto markets are available to trade 24 hours a day, 7 days a week. So right now it's at extreme greed at 79 points from 71 points last week. So our review of industry performance, this is going back to the stock market. For the past week, basic materials has provided the best returns for the past week, followed by real estate. And for the past 6 months, energy, as always, have been consistent, up 22 percentage points as an industry, followed by technology. And for the past year, energy is still number one, 81% up. Incredible, almost double, 100% is double. So nearing double rates. And followed by financial, which is at 46%. Well, overall, for the past year, each and every industry is up, except, well, each and every industry is up. Only utilities it's up 5%. You know, not that great, but still pretty much 5% is good compared to 0% return or negative return. And for the flow, so this is what I got from Barron's. They give this on a weekly basis. We also get our flows from Bank of America, but on this week's episode, we're going to look at Barron's flows. So for equity funds, looks like it's in a downdraft for this week. A little bit of outflows. It says here redemptions sank the last month's average weekly cash flow. So it's redemptions that sank last month's average weekly cash flow at equity funds to negative $2.9 billion. So some outflows happening in the equity funds, while money market has improved. Money market funds, for our listeners who are not familiar, money market is like the cash market. Like, in my understanding, correct me if I'm wrong, Wowie, it's like a deposit, money market fund that you can withdraw every 30 days. So money market inflows jumped to 15.8 billion, while equity flows had a negative 2.9 billion outflow. So people probably in the past month have been a little bit, yeah, September hasn't been like really an outperforming month, right, Wowie? I think that's when the market kind of like stagnated a little bit, had some.
Yeah, it went down
Mhm.
Early September, right? And
Yes.
it's just the last 2 days of last week was when we had some bull runs.
Right. And it's already the second week of October. So this explains it. People trying to be a little bit conservative in September and early October, which is, typical because we've been always having the ever so like all-time highs every day just a couple months ago, each and every day, all-time highs. So for the performance of the markets, different kind of indices, we have here the S&P, NASDAQ, Dow Jones, and the Russell. So we have started to include the Russell because it's small caps. It's a small caps universe. So we need to pay attention to the small caps as well. So for the past week, in fact, the Russell 2000 is the outperforming index, up 2%, 2.12% for the past 5 days, followed by Dow Jones, which is the reopening place, the industrials and the banks, up 1.75%. S&P 500, the 500 largest US companies, almost hovering a flat 0.4%. And lastly, the underperforming index, the NASDAQ, or the heavy tech index, which includes Google, Facebook, Amazon, the FANG, you know what it is, Microsoft. They're the ones who are lagging for the past week, negative 1.4%. For the past 6 months, though, NASDAQ, even though underperforming last week, is still the best performing index for the past 6 months. It's up 8.4%, followed by S&P 500 at 7.5%, followed by Dow Jones and Russell. Russell is like up 1% in the past 6 months. And for those who are long-term investors who would like to know for this year's performance since January 1st, the top performing index is the S&P 500, which is up 20.8%. So if you invested $10,000 in the S&P 500 alone, it would have gained 20.8% or $2,080. Followed by NASDAQ up at 19%, and then Dow Jones, and then Russell. Russell, even though in the past 6 months it was flat, it's still up 16% for this year since the start of the year, hovering similarly to Dow Jones Industrial. So I guess for now, as I've been sharing to our little group, Wowie, I'm tech heavy. So since the start of the year, I've been slowly rotating my stocks to growth, which includes Google, Amazon, and Facebook. So I was able to at least you know recover, or much more than in terms of like just being stuck with my bank's investment, like financials and oil.
Mhm.
I was able to
Mhm.
reap some benefits by being invested in growth companies. I believe you still have Tesla as your number one holding, right?
Yes, yes. So I still have Tesla and Amazon, and
Right.
I'm gonna keep it for the long term,
Yes.
especially Tesla.
I think.
Since
Mhm.
they're still completing their factory in Austin, and
Oh
they're
yeah.
gearing up for production in Germany
Oh
uh,
wow. Okay.
late this year. So looking forward to seeing what's gonna come on with that. They're just
Yes.
waiting for final approval on the building.
Yes.
So they should ramp up production pretty soon, knowing, Tesla, they're pretty fast when
They
it
push
comes
hard.
to
Yeah.
production.
They push
Hmm.
hard because I remember reading an article where I'm not sure if it's a whistleblower. I don't think it's a whistleblower, but probably disgruntled employee
Hmm.
where she got fired because she told Musk, or indirectly told the manager, that they won't be able to hit the target, the production. And the following day, Musk got pissed and had like fired this person because of that scenario. That like he just doesn't accept like negative outlook, or people who don't try to push through or meet the goals of the company. And also, yeah, I think electrical vehicles are the only segment of auto industry that had grown, this time in the Chinese or China auto industry market. It's been very alarming what is happening to China, especially the real estate market, the collapse of Evergrande. And as of like this week, I saw a news that auto sales have been slumping as well, like down by big percentage, 20 to 30%. But
Hmm.
their EV sales are still up. So I'm not sure if the people are just buying EVs, or there's the total like slowdown in consumer sentiment over there in China. Oh, so for those who may not still be familiar, China is like, if not the second largest economy in the world. So indirectly, they can still affect our global trade, and indirectly affect U.S. economy somehow if that continues. So the financial condition index. So this is the slide from Chicago Fed. Um, so let me just explain why I have this chart here. It just explains the condition of the economy as a whole. So the Chicago Fed's National Financial Condition Index is a comprehensive weekly update on U.S. financial conditions in money markets, debt, and equity markets or stock markets, and the traditional and shadow banking system. Positive values um, that are tighter than average indicate financial conditions that are tighter, while negative is the looser than average. So we always want to see this like hovering near recent performance. That way, because if it suddenly spikes up, it means the financial conditions are tightening. And usually this is when businesses start to reflect slowdown in investments, and further could affect our economy. So for the past week, well, this is not the past week, for the past 12 months, for the past year, financial condition index have been trending down from negative 0.45, which is looser. It's anything less than zero is loose. From negative 0.45 it's trending down to negative 0.72 as of July of this year. But from that point on, we are slowly trending up. So this is something to keep an eye on, but we're still in negative area. So nothing to worry about, I feel like. And if you're going to look at it on a historical basis, we're still at the lows of its more than 50 years history. So on our next slide, this is the University of Michigan consumer sentiment. So this is a slide that I gathered from Charles Schwab, Liz Sonders. So according to her, the sentiment in this chart is down, actually, a downtick in October this month to 71.4% from 73% last month. Oh, sorry, from 72.8 from prior month. So the estimates were actually for the sentiments to increase this month to 73, but instead it downticked to 71%. So why the importance of mentioning this chart? This is because consumers drive this U.S. economy. More than 2/3 of the U.S. economy relies on consumers. So right now, consumers are probably feeling the heat. Correct me if I'm wrong, Wawi, because I think we're now at the highest of inflation in the past 13 years. So it's kind of dampened the mood in terms of spending, a downtick instead of an uptick.
Yeah, our consumer price index is up 5.4% from a year ago. So that's a good indicator for inflation.
Inflation. Oh, speaking of inflation and 5%, I think you shared an information regarding Social Security price hike, or not price hike. Is it in the checks payout? Is going to increase around 5% as well, starting next year?
Yes, so they're going to adjust it. This is what I got from the news. They're going to adjust Social Security payments about 5% to adjust for inflation. That will help a lot of our retired persons here in the U.S.
Right, and I heard over the news that it would tantamountly amount to, it would amount to around $98 per check as an increase. But experts are saying that they don't see this as a permanent change. They're just seeing this as a transitory change. 5.9% is a huge jump in payouts. So I wonder where this payouts would be going to. You think it'll just go back to the economy, Maui, or just go to the next GameStop?
Well, if they're trading, it may go to GameStop, right? But we're talking about retired people, so they're on fixed income, so most likely they'll keep that to pay, like medical bills, or maybe their rent or transportation. Who knows? But these are people that are on fixed income, so they will use it for their basic necessities.
So back to the economy, more likely. So this is a slide from real estate sources from Redfin. They come out with this data every once in a while. I think once a month. So we'll just discuss probably 3 or 4 charts from this slide, which is very informative about the real estate market here in the US. So home sale prices are up 13% as of October, averaging around $354,000, 750 per home sales. This is up from 315,000 last year. Asking prices on new listings is up 12%. Gonna look at some new listings. So this is where we're looking to see if whether the inventory has increased over the past year. So new listings of homes, it's still down 8% from 2020. So 4-week rolling average of new listings of homes for sale is 87,000 listings, down from 94,000 last year. Active listings of homes for sale is down 21%. So it looks like the inventory is still not creeping up on this like chart. that we're looking at based on Redfin information. 46% or nearly half of pending sales under contract within 2 weeks. So they're still knocking them down once they're listed within 2 weeks. Almost 50% gets taken out of market or placed under
Yeah.
contract or have received offer.
Still a hot market for the
Hot
housing.
market. Yes, and congrats to you, Wowie, and being for closing in on your new acquisition.
Well, thank you, Mark. We just did close on our house yesterday.
That's amazing.
Yeah. So what was amazing was they were surprised that we just had one loan agent that helped us through the process.
Mm-hmm.
They said that normally they would see more than one person that the buyer has to deal with when they're trying to complete the closing process.
Mm-hmm.
So we got our, and this is not an advertisement, we
Sure.
got our loan from Bank of America.
Oh, okay.
So a big thanks to Bank of America. We've been a Bank of America customer for many, many years.
Mm-hmm. Wow. Well, congrats. I hope you guys enjoy your new property. You guys deserve it. All the hard work.
Yes, thank you. Thank you, Mark.
Mm-hmm. So yeah, going back on the slide from Redfin, days on the market. So while the inventories are slowly, treading along, still low, 8%. But days on the market, this is what I've noticed here. Looks like it has increased. Listings have stayed on the market for a little bit longer. Now in October, it's up to 22 days on average compared to 15, lowest point back in July. But still, comparing it to last year at the same point of time, days on the market of properties were at 32 days or at least a month. So, yep, the what do you call it? Turnover is still fast.
Yeah, well, the monthly supply of houses in the United States are still not at its highest.
Mm-hmm.
When it was at 2010, that was the peak of the monthly supply of houses. Right now we're at let's see what that number is. Oh, I can only see June 2021, 6.1 versus at its peak in 2009 at about 11.
Oh, that's a good information right there. So we're still way below in terms of housing supply. So here we go on the next slide. 5% of listings had price drop. So there has been an increase in listings price drops compared to January's 2%. Now we're at 5%. So it's slowly increasing or creeping up in terms of price drop. But look, if you're gonna see the overall trend for the past 3 years, including the COVID period, it looks like the price drops peak somewhere around this month, October to November. So if history provides any guide, looks like we're gonna have a trending down or less housing price drop. If there's any time to any good time to buy, it would have been between September and October in terms of this chart, because price drops increase during this period of time, at least in the past 3 years, including the COVID year.
And that may be a seasonal buying trend.
Mm-hmm.
So most people might be staying at home during the holidays instead of shopping for new homes. You may see
Makes
a
sense.
rise. Yeah, you may see a rise in home buying again by spring and in the summer.
Mm-hmm. Yeah, I think you're right on that for sure. And then there's a sales to list price ratio. So this just means if people are overpaying, looks like people are a lot less overpaying nowadays. It's back around 100.7% compared to 102% back in July, where it was really red hot during those times where people like overbidding or overpaying. I think we played a clip back then with an interview of this realtor in Austin, who's saying that people are not even like looking at the property and bidding more than $100,000 per property, which is just nuts. $100,000. And the most important chart or slide from Redfin, is the Redfin Home Buyer Demand Index. So this index is still up 7% from 2020. And it just shows that the buyer's demand is still there. We have a sound real estate market. We'd be scared if we see a huge drop like what happened during the COVID lockdown, but looks like it's not in the horizon as of yet. So it's just a good sign.
Well, I speaking with my realtor, she said that within the next 4 years, we may see some, still a high demand for homes, and then it will start leveling off, according to the expert she's talking to. But Goldman Sachs also says that home prices could still surge another 16% in 2022 as the supply-demand mismatch continues. So this is what my realtor is saying, according to the expert she's talked to, and Goldman Sachs is also saying the same thing. But let's see how long it's gonna take. So her experts tell her about 4 years.
4 years of still housing price growth. Oh wow.
Yeah, that's what they're seeing before it starts leveling off.
That's crazy. That's a long period of time. We need to buy a house now.
Maybe another 10 years. I don't know. So
Yeah.
what we're looking at is our land. Okay, so looking at land in Texas, it's another hot market. If you're in the city, like Houston, the acreage are getting smaller. But if you go to the panhandle of Texas and West Texas, you could still buy tracts of land, big tracts of land, including East Texas. You could still buy big tracts of land, averaging about $6,000 to $7,000 an acre.
Oh wow.
But I remember when I was here in the early 90s, it was just about $500 an acre north of Tyler. So things have changed a lot. Texas is a hot housing and land market at this time. People are moving into Texas because of the business environment and
Right.
low taxation. So
It's a healthy environment.
yes, it's a healthy environment for people and for business. So
Right. As
Texas
I
is
was
booming.
as I was refreshing this, I'm gonna segue to this, I guess, while our next slide would have been the Bloomberg article about the sentiments of Wall Street, but
Mhm.
here it just popped up. Breaking news: Netflix estimates Squid Game will be worth almost $900 million. Have you seen
Wow.
this clip or this episode series? Ron?
Yes. My family binge watch it for 2 days.
Oh, 2 days, and it has like 9 episodes, right?
I think so. I slept through some of it.
Well, I don't blame you, but yeah, it's quite an interesting episode. Yeah, it's quite brutal, but gory, but life and
Mhm.
death. So it says
South
here. Mhm.
South Korea has really exported a lot of their movies to the
Yeah.
world, and their movie making industry is one of the largest in the world, and they're garnering awards for a lot of these movies that they are producing. And Squid Game is really an exciting movie to watch while I was awake.
Mhm.
I'm sorry. It is an exciting movie, but they usually watch it at night when I'm about, I usually turn in at around 9:30 or 10. So
Mhm. Yeah, likewise. But you know what's interesting about this Squid Game is I believe back in 2017, I think Wall Street Journal ran an article about the Squid Game's producer or the writer. At one point, he was in a challenging financial situation where as he was writing the script for the story or for the Squid Game, he actually had to pawn or sell his laptop, and he wasn't able to finish the script because he needed the money. He sold it for around $600 to help his mom pay for the rent. So
oh,
it was like, it's real. It's for him suffering the financial situation or hardships during that time, kind of like probably influence more, putting more personal touch or in fact reflecting a lot of like live or die
Yeah.
situation in the
Yeah, the
series.
movie is indeed a movie about struggle
Yeah, for
and
sure.
about human nature. So
Yeah.
wow, so he got a lot of his idea from personal experience then.
Mm-hmm. Mixing it with
There's
kid
interesting.
playground games and life and death situation as a result. So it says here more than 130 million people have watched the Korean show.
And
Um,
growing.
and still growing. And looks like I think I saw a number of billions here. It says here, all told, people have spent more than 1.4 billion hours watching the show, which was produced by closely held Siren Pictures. Well, the thing about this is, one thing about Netflix is that they've been really increasing their spending overseas. In Korea, they've been spending hundreds of millions of dollars, and I think they're gonna go over half a billion mark this year alone. So yeah, going on to our next slide, it says here, this is a Bloomberg article published just last night or yesterday. The title is Wall Street Analysts Echo Crypto Bulls and Seeing Nothing But Gains Ahead. So this title alone kind of
Mhm.
like gives me some sort of like icky feeling just because if people are getting bullish as reflected in the sentiment crowd in the AAII investor, so this is the one thing that we need to closely keep an eye on if people are getting more and more optimistic, which right now I'm not being a doomsayer or anything like that. We're still low in terms of being compared to history. If you're going to look back at the AAII sentiment, we're at 38%, which we in terms of comparison historical averages, we're at just hovering at the similar historic pattern, which is at 38%. But for the past year, the most bullish that we've got was at 56.9% or 57% back in April 7 of this year. So we're still ways from that. So I don't think this is not so troubling. Although this Bloomberg article alone kind of like gives me a hint that I need to be, or at least we need to keep an eye on this raging bull or the bull comeback. So it says
Mhm.
here the byline rise of 20% seen for almost 1/5 of stocks in the S&P 500. 1/5 or 20%. How many is that?
Mhm.
20% times 500. That'll be 100 companies. The top, well, not the top, but the 100, at least 100 companies in the S&P 500s. Their stock price would at least rise 20% according to analysts. Bullish price target suggests that there's a big surge for battered stocks. So those stocks that have been falling, this may be their time to shine. Analysts expect almost 1/5 again, to rise at least 20% in the coming year. A degree of optimism not seen at this point in the year since 2018. So it's been 3 years since we've seen this bullishness from Wall Street analysts. So looks like the bull has come back for good. So
Yeah. Well, we'll see. We saw the first glimpse of it last
mm,
Friday.
right,
So a lot of the battered stocks have risen up, including some of China's stocks have gone up.
right. And in this article, they have highlighted at least one, two, three, four, five, six, seven stocks. Gap is down 21% for the past 2 months, but average analyst price target would indicate a 69% return if it reaches $38 a share. Western Digital is down 12% in the past 2 months, but average Wall Street analyst sees a 61% rise in its stock. T-Mobile down 18%, sees a 43% upside. Biogen 42% upside. Hanes Brands has a 32% upside. Under Armour has 30% upside. Bristol Myers sees a 29% upside. So quite a promising return looks like in the coming year, which doesn't indicate a troublesome view. Um, but still, going back to the sentiments, we're still ways off from being overly exuberant. So this is an article from Market Watch titled Jeremy Grantham is right that there's a bubble. This strategy says why right now is a good buying opportunity for stocks. This has been published yesterday. Um, says here, As commercial banks healed from the global financial crisis, central banks adopted zero or negative interest rates, then quantitative easing to offset the absence of lending and money creation. That in turn has crowded out private sector ownership of private sector listed assets and pushed market participants up the risk curve. That has landed markets in place where not just the US, but many global stock markets have elevated to price to earnings ratio. And in response, investors are all in. The US household equity allocation as a percent of total financial assets has climbed to new highs. Corporation stock via stock buybacks and foreign central banks, such as Bank of Japan and Swiss National Bank, are also buying equities aggressively. So this article is saying that everybody is getting all in the stock market. And it says here, Watling, must be the expert and the strategist, agrees with GMO co-founder and market historian Jeremy Grantham that markets are in a bubble. But far from recommending investors get out, he said now is a good tactical opportunity. Quote unquote, it ends when central bankers change their behavior. And therefore the question is, when do they change their behavior? And I think the answer is they change it when inflation becomes something that is of concern to them, he said. For now, Federal Reserve Jerome Powell, with evidence, can say inflation is a temporary phenomenon driven by the impact of COVID pandemic and supply chains. So they still, I guess they're still thinking that it's still transitory, although they already increased the Social Security paycheck. There's no taking that back. I don't think they'll be able to take that back moving forward. It's no longer going to be transitory, the 5.9% that Huawei has said earlier. So this is something to keep an eye on for sure, if they still think inflation is transitory. But as we have discussed in a previous episode, actually the Fed is thinking of raising the interest rate or Fed rate hike, if not this coming year end or early next year. So there's definitely going to be a change coming pretty soon in sentiments. So according to this strategist, quote, I think what we're going to get over the next 6 to 9 months is a backup in bond yields because the economy is accelerating as the pandemic turns into an epidemic. So a less serious, but still, dangerous type of situation. And therefore, money is coming out of bonds, going into equity markets in the first phase through the middle of next year, and maybe a bit longer. What do you think about this, Huawei?
Well, they're likely gonna taper either November. Well, I think by November they will taper, and of course the market, and of course the market would respond to that, and so just brace yourself. Markets will do that. What I really think is the growth of the stock market was stunted by the COVID-19 epidemic. Just remember, it was on the rise before February of 2020, before we started hearing about the news. And by March, when we started seeing that this is a deadly virus, we saw the rapid, increase. Increase in cases, and then the response of the market was to go down. So we did see a big down drop in May. But if you look back before the pandemic, we were on the rise. We were saying that, everything is so high, so high, so high, so high. And then it dropped. And now we're back at that same discussion. Everything is so high, so high, so high, but we are not yet fully open. We are not yet fully open.
Right.
And so I think the catalyst here for a change would be the Fed tapering, but I know they're gonna taper slowly, so the market can adjust. So, but of course, fear again on the market will rise, volatility will rise. So expect some drops, if they do taper in November. But I think, the market has been wise for this experience, and maybe they're more resilient. Maybe people and hedge fund managers will hold their positions. We will see. But I have a bullish feeling about this. I think for the most part, people will hold their positions.
Mhm.
But again, that's me. I'm a
Right.
bit more bullish than most.
Right. And sentiment wise, you know, you are not alone. Looks like
Yeah.
people are getting more bullish. So
Mhm.
retail sales, well, which was released earlier this week, has oh, it went away. The
Mhm.
page has refreshed. So I
I
got
think
another
they're
chart.
gonna delay Christmas by 30 days because we're still waiting on our Christmas gifts on the port of LA.
It's stuck at the port of LA. So September retail sales logged a positive 0.7% compared to 0.9% last month. So this is an upside, although a little slower compared to last month. Estimates were in fact negative 0.2%. So September retail sales have definitely beat expectations.
Yes.
And we're seeing more retail sales happening. And let me see here in the breakdown by Charles Schwab. More retail sales seen in e-commerce as a segment, up 5.7%, followed by food and beverage, positive 2.2%. Slowdown is observed in vehicles. This would be the second month, I think, vehicles and parts are slowing down.
Mhm.
Electronics and sporting goods, interestingly.
Well, out of those three, the only one that don't have a chip in it is sporting goods. Well, it depends on what kind of sporting good we're talking about.
Right. So according to this article from Fox, apologize for the for the volume there. Quote unquote. People who are back to working in a downtown office may be taking more shopping trips to their shopping trips on their lunch break or after work, said Natalie Cotliar, national leader of BDO's retail and consumer products practice. Quote unquote, with school back in session and many teens vaccinated, parents may also be more comfortable allowing their teens to take shopping trips to the mall. So mall shopping is back and alive.
That's good.
Good news for retailers such as Target and Walmart for sure. Ross stores.
And raw stores.
Mhm.
Yeah, raw stores keep adding stores.
Oh yeah, I think
Yes.
they're over how many? I'm not sure.
I am
But
not sure, but they keep adding stores,
I know,
and
yeah.
I'm looking forward for an upsurge in their stock price.
Oh yeah, you have investment in Ross stores.
Yes, I do. I did liquidate a few last year to take profit, but I kept some, and looks like they're doing fairly well.
Mhm.
But since since holiday season is nearing, I think we'll see an upsurge in sales here
Right.
in a few weeks.
Right now it's at $108 a share. And let's see how has it performed for the past year. At least since the start of the year. Oh, it's down 7%. It's trading between $110 to 130 at least in the
Mhm.
past year.
And like I said before in the group, this is somewhat like my benchmark for reopening
Mm,
my raw stores company, because it will tell me, how people are going out, how comfortable are they going out shopping, bargain hunting.
right. So now we're going to our roll the clip segment where we're gonna play some video clips, interesting Wall Street interviews in the past week. So for this week we have three. We're gonna start with a little bit of pessimistic view in the coming months. This is an interview by CNBC. It happened on October 14th with almost 30,000 views. The video's title is Former Top Bank Regulator Puts Financial Crisis on Watch List, Sees Asset Bubbles. Okay, without further ado, let's play the clip.
Our next guest had a front row seat during the financial crisis, and she is worried a meltdown could happen again due to risks tied to Fed tapering and stimulus measures. Let's bring in Sheila Bair. She was FDIC chair from 2006 to 2011. Sheila, great to have you with us.
Thanks for having me.
Choosing the term financial crisis is really tricky because it's like you're shell shocked and you think back to the great financial crisis, but you chose it very specifically, and I'm wondering what you see could be the scenario here.
Well, I don't think it'll happen. I think it's avoidable, but I do think interest rates are going to go up. I think that asset valuations are elevated pretty much across the board. And a lot of that's driven by monetary policy. So as monetary policy becomes less accommodative, some of those valuations are going to start dropping. So I think you can do that on a slow, steady basis. But let's not forget what triggered the 2008-2009 financial crisis was when the Fed just went a little bit too fast on their interest rate hikes. And so this is very tricky. And the history of tightening is not always a positive one in terms of being able to exit these accommodative policies without a negative impact on the economy. So I think it's avoidable, but I think the Fed's got a very significant challenge in front of them, starting with tightening with taper and then eventually interest rate increases.
Sheila, it's Tim. Thanks for joining us. Is there a part of the economy? It was easy to look at banks in the pre-crisis lead up as taking excessive risk and the inability to value derivatives. Banks seemingly have very different balance sheets and business models. Where are you concerned in the private sector?
Yeah, so they're in better shape. Are they as good, as strong as they need to be? I don't know, but they're in much better shape. They have de-risked. A lot of the risk has gone outside the banking sector. So there is another crisis. I don't know if it's necessarily going to be with the big banks, but there's a whole financial ecosystem out there that's pretty highly leveraged. The corporate sector is very highly leveraged. A lot of reliance on short-term debt. Again, that's going to create stress for the weaker companies. They're going to have to keep refinancing, and the rates are going to be going up. So I don't know if it's going to start with the banks. It'll probably start outside the banks, but I hope it doesn't happen at all. Again, I think and I have been a longstanding critic of this highly accommodative monetary policy, but I tell you now, I think they need to go slow. Jay Powell suggested that they would, end taper by mid next year. That's pretty rapid. I would rethink that. I think they need to do this. I think inflation's a real concern, but it needs to be very gradual because, it's been a long time since interest rates have gone up, and we're just not quite sure what the optimal home is going to be.
Sheila, it's Karen. Thanks so much for being on. Let me ask something about. It sounded like you were concerned about banks being, sort of in '94 there was that negative duration, but now they're so asset sensitive. It would seem like that wouldn't be a risk. Are you more fearful of credit quality from corporates becoming underwater?
Yes. I mean, again, I don't think this is necessarily going to start with the banks. The banks are better capitalized. They have to deleverage to some extent. I think it's going to happen. Yeah, but sure. Even if it starts someplace else, it's going to cascade back into them. Corporate debt, a lot of it will be, experienced in the financial markets, though. A lot of these assets are not held on bank balance sheets. So again, I don't think crisis is necessarily going to destabilize the banking system. It may, we just don't know. But I think there is a real risk of financial turmoil. A lot of investors getting hurt. And if it cascades into a negative economic situation, a downturn or recession, we could have a problem, and that's going to create credit losses that will flow through back to the banking system. So I think all of this can be avoided, but the Fed just needs to go very, very slow.
Sheila, I'm curious.
It's a long time.
Yeah, I'm curious to hear where you think this could start. And it sounds almost like you're alluding to the shadow banking system and the entities that have lent money to various entities that may not be as creditworthy. And how does that, if it's in the financial system, in the banking system, there are bailout mechanisms, which we've seen in the past. But if it happens in the shadow banking system, we've never crossed that bridge before.
No, we haven't. There will be, hopefully we will not have to, because I think longer term, that's even more destabilizing to the extent that some of these non-bank players, prime example, many times, asset managers, they've already gotten, targeted bailouts already. So I think there is a bailout kind of thinking has already set in to a lot of these non-bank sectors that incentivizes risk taking. So, and I do worry about the corporate sector a lot. And again, that could certainly have a very, very negative impact on corporate debt markets. And if that cascades into the real economy, then it's going to flow back onto bank balance sheets. Look, I think another possible scenario is not crises, but stagflation. I think there's, we've got constrained supply. We've got a huge amount of monetary and fiscal stimulus still flowing into the economy. Could be a lot more coming out of Washington. If supply is constraining economic growth and we keep pouring fuel onto the demand side, you're going to end up with stagflation, which could be another very ugly scenario for working families. It might not hit the banks so much or the financial markets so much, but it could have a real devastating impact on working families, lower income workers who are just finally now seeing some real wage growth. So that is another area that's very high on my worry list.
So I don't want to put words in your mouth, Sheila, but it sounds like you think that the potential outcomes, that's a higher risk for negative outcomes coming out of easy monetary policy than positive outcomes.
I think I think asset valuations are going to adjust. I think, borrowing is going to become more expensive to some extent. Long term, that will be a good thing, but yeah, short term, it's going to be a very difficult transition to navigate. And, best of luck. We've got a lot of talented people at the Fed. So, and I know, they're thinking about this morning, noon, and night, but they really need to be very careful and very gradual on how they start to.
So I think we're going to cut the interview there because it's been quite a while. But yeah, lots of things to consider, looks like, moving forward now that Fed is thinking about raising rates, according to this lady. Wowie, looks like even if the Fed starts its hike by mid next year, which it's clearly, telegraphed. I mean, we're actually already thinking by probably end of this year or early next year, but mid next year, it's still considered a rapid response or a rapid rate hike, which would definitely entail an increase in interest rates, which she said that could affect smaller companies who have more debts and we're going to have a hard time financing their situation, their financial, their operations, which can then return affect banks as a result. Quite complicated there.
Yeah,
And,
well, if you're looking at the traditional way of funding, there's a lot of, other funding sources now, like, crowdfunding, like Start and, for new companies, like Start Engine. And then you look at all these companies that are helping, struggling companies recover, like, Blackstone.
right.
And those that are doing mergers and acquisitions like Moelis and Company.
M&A, yeah, I think it's been increasing so far this year. We've
their
seen
positions.
Mhm.
I know. So what I'm seeing is, we might see non-traditional banks providing safe havens for these smaller companies or even large companies that are struggling through the shift. So I don't see what she's seeing. I'm seeing that the market will adapt because a lot of these other companies have already positioned themselves to pick out, okay, who is still a winner? Can we help them? Can we restructure them? Okay, let's go in. And I'm talking about companies like Blackstone doing that.
And one more thing that I think she clearly pointed out, which could be one of the other reasons that could slow down this eternal bull that we have been experiencing since the lockdowns, a stagflation that can actually happen and affect the entire economy, not the Wall Street per se, but it could hit the working families, according to her. Whereas there's a tight supply chain or constraint, products or stuff that needs to be, that are demands that aren't being meeting the demands of consumers. Therefore, they ended up paying more, or eventually they're probably turn out a consumer fatigue or some sort, and there be nothing like price price stagflates or at least comes to a slowdown.
That's what I'm
And-
saying. If products don't come in on time for
Right.
the holidays, then people will not buy them on time,
I know.
and they will just be left in the shelves.
Mm-hmm.
Um,
And that's
but
bad.
well, they're working on it. Supposedly, these big box retailers are working,
Right.
getting their own ships, getting their own trucks, even
Yes.
flying these products to
Yes.
their warehouses or something.
Big companies, yeah. Walmart, Amazon, Target, these people have hired ships, vessels that will
Mhm.
directly ship their products from China. So the big the big people are being able to at least accommodate for this supply constraints.
A lot of logistics lesson this pandemic season, and that will make the market more efficient by next year for all the lessons they learned this year
Right. So
and last
here's
year.
so here's another interview that happened. This is 10 days ago by Bloomberg. It has 18,000 views. It's titled, "There's Been a Correction Under the Surface," Sonders says. So Sonders is a Charles Schwab strategist or chief investment officer. Let's roll the clip.
And we've seen the dip buyers come in or at least rotate into maybe other pockets of the market. It didn't appear that there was a lot of cash coming out of the market, but we've heard from a lot of folks over the last few days, basically saying that, hey, now would be a great time to take some money off the table.
So I think that you're right. We've not seen a significant change in terms of cash positions. There's been a lot of churn. And what I think has happened more recently in terms of at least the cohort of retail traders, some of the newer entrants into the market over the past year and a half or so, there has been a market shift in their attention away from some of the highly speculative areas, whether it was meme stocks, heavily shorted stocks, SPACs. You could even put crypto on the list. You can look at other sort of lower quality areas, bankruptcy stocks. And that really came to fruition in terms of that cohort's maximum drawdowns in the sort of February to May period of time, where across the spectrum of many of those areas, you were talking about drawdowns of at a minimum 30%, in some cases in terms of the meme stock 70 or 80%. And then more recently you saw a shift into some of the more traditional averages, into some of the FANG stocks. And there hasn't been enough pain yet probably to have that cohort now be looking for the next shiny object, but it is going to be interesting since their attention is no longer just in these non-traditional segments of the market.
Now that takes care of the day traders, right? The retail traders, but the big institutional investor, we've heard over and over the last 24 hours, this idea of a correction. And I'm wondering what that means to you in terms of kind of what you wait for to get past to really start buying into this dip in a real more significant way.
Well, we've had, plenty of correction even within a benchmark index like the S&P. Through yesterday's close, 91% of the S&P's constituents had at some point this year at least a 10% drawdown from highs, with the average being negative 17%. By the way, in the NASDAQ, it was 90% of stocks with the average drawdown being 38%. Wow. So pretty deep bear market territory. But that's the nature of rotations where there's been significant weakness. That weakness is spread around various segments, and at times where there's the greatest amount of weakness, there's offsetting strength. That has kept the overall indexes afloat. To see an environment where at some point the index level catches down and goes into correction, it wouldn't surprise me at all. But a lot of that correction has already happened under the surface. So it's been a correction via rotation without the index itself reflecting that, at least not yet.
Zan, you were talking at the very start about how this has been rotations under the surface and they happen very swiftly. It feels as though now more and more are saying it's time for value. It's time to get into banks, for example, to offset inflation risk and offset interest rate increased risk. Do you buy that in the longer term, that what can take us higher? Because
I buy that you want to look for value now, but shame on anybody that doesn't go at least one layer further and explain what you're talking about when you're talking about value. Because even if you're talking, say, as a passive investor about the value indexes, look at the difference between what's in the S&P value index or the Russell 1000 value index or the Russell 2000 value index. If you have a positive financial story, yeah, then you have a positive Russell 2000 value story because it's about 28% of the index, but it's a lot less in those others. You can look for value outside of areas that live in the value indexes. Another kind of reverse example is utilities. Utilities are really expensive right now. In aggregate, they have a higher PE than the S&P. They're not value stocks, regardless of the fact that they live in the value indexes. So I think you want to take a value approach, but have it be a hybrid approach. Look for value characteristics. Don't give up the growth. Have an overarching overlay of quality. And apply it regardless of whether you're looking in financials or you're looking in tech or you're looking in healthcare. And that has been the most consistent outperformer even throughout this rapid fire rotation. So I think investors should take a factor approach more so than some predetermined style index approach or even sector approach.
I do want to get a quick question in here, Lizanne, about some of the moves that we've seen in the commodity space here. We've been talking a lot about energy, but we're now starting to see a lot of price pressures when it comes to the soft commodities, including cotton. We're heading into an earnings season where a lot of people are looking for some commentary about some of these price pressures and whether companies are able to either absorb those costs or pass them along here. Are you worried at all about what we might hear out of some of these companies over the next few weeks?
So I am, first of all, I'm very worried about what's going on with energy, and not so much just tied to the stocks or sectors, but some of the serious problems that are starting to creep up, whether it's in UK with natural gas and the connection there to Russian supplies, whether it's what's going on in China and the need to have kind of, forced rationing of electricity, and Brazil and India and the feeder effects. And I think there's not as much attention on that whole broader macro topic as there should be. In terms of the answer specifically to your question about companies, I think the margin story is at least as important to listen to in third quarter reporting season than just what the beat rate is for the quarter. Yeah. To see whether companies have that ability to pass on these higher input costs, and in turn, what the pressure might be on what have been still very robust profit margins. That story may be changing.
Ooh, that story may be changing. Profitability might be slowing down, looks like. Kwewawi.
Oh, really? Is that what you're seeing?
I think that might be the case. It's not been showing yet because we just started the earnings season this quarter. For the recent quarter, banks have just started reporting, and I think it's been a blowout quarter still. Goldman Sachs, Morgan Stanley, Wells Fargo, all showing good signs of profitability. But we have to take a closer look at the industrials for sure. If they're able to pass up higher costs and higher prices to consumers or to other factories and producers over time. But yeah.
It's another earnings season, so this month we'll see. We'll see what the reports would show us.
For sure.
But Lisa Sonders make a good point though. With a lot, well, for at least for retail, looking at new homes, they have to fill up these homes with furnitures, right? So.
Well, that's true. Yeah.
Wayfair, Amazon might benefit from all of this home buying. We'll see. Sherwin-Williams.
Oh yeah.
Paints.
Yeah.
So just looking at that retail side of the story, but she may be right. The correction may have already happened. Looking at the Russell, 2000 market, right?
Slowly creeping. It's a rotational correction, like what Morgan Stanley also pointed out in our last week's episode. It has started even like since mid this year. We just haven't felt it because the leading stocks, which are the big stocks, like the largest companies, have been carrying the torch for the rest of the companies that are listed. So let's go ahead and roll the last video clip that we have for this week. It's an interview with Morgan Stanley CEO. I think this is James Gorman. He also contracted COVID, by the way, I think,
Oh.
sometime last year, and was only a late announcement after learning the fact. So the title is Morgan Stanley CEO says Fed has to move aggressively. So this is a way in contrast to the first interview that we have reviewed with Miss Bair, who was a former, I think she's a former FDIC chair or something.
Yeah, FDIC chair.
Yeah, let's see. I can't. Miss Blair. Here, Sheila Bair, former FDIC chair. So she's saying the Fed has to be careful, really careful of increasing the rates. But this guy, who's the CEO of one of the largest banks here in the US, Morgan Stanley, says the Fed has to move aggressively. So I think he wants to have a market crash. Let's roll this clip.
Where can we expect you to expand the most in the next 6 to 12 months?
Well, there's still a heck of a way to go, Shanali. Firstly, thanks for having us on. But we've got a lot of things in motion. We've just started really the whole workplace strategy, and we have several million clients that we brought to the firm through Solium and through E-Trade. That's just kicking off. I mean, the asset flows coming to the wealth and asset management business. I think we're about 400 billion year to date in new money that's come in. And then we're continuing to see share gain and extremely good performance across the whole investment banking, sales and trading platform. I don't expect the investment banking pipeline to slow down at this point. It remains very robust. And then as eventually the Fed starts tapering, move to rate increases, you're going to see more volatility in the fixed income space, which we'll participate in. So there's a lot of stuff going on right now.
Well, let's speak to those challenges for a second, James. You had said during our earnings call a little bit earlier to watch out for volatility. Many of your peers have been very worried about interest rates. What are you most worried about as we start to close up this year still?
Well, I think I just said you've got to be mindful. I mean, we're seeing sharper movements in the market by the day. Some of the sort of earlier bubbles around SPACs have clearly gone off the boil a little bit. There's more geopolitical tension between the US, China, talk of Taiwan, etc. So I think you've just got to, our job is to be mindful and to, on the one hand, have your foot on the accelerator, but the other, constantly be looking for where the big potholes are. And that's basically what I mean by being cautious. But honestly, in the next several months, I think the market has digested that the Fed will have to move, not just on tapering, but on rate increases. And by the way, we're 10 rate increases away from what would be considered normal. We could do 10 quarter-point rate increases. So bringing it up a little bit over the next year that's not a crisis and not unexpected.
So you said not a crisis. So do you think that a lot of people who are worried about the next correction in the market, are those fears misplaced?
Oh, the people are always worried. I mean, markets go up and go down, one wise person once said. And, when you've got basically free money, record fiscal stimulus, global synchronized growth, of course the market's going to do well. I mean, whenever are they not going to do well? If this environment doesn't make it happen, none will. But that doesn't mean that it's going to go in a straight line forever. I've been doing this a long time. You have corrections, you have moments of excess, you have reassessments, the investor's psyche changes. We'll go through one of those periods, but I'm not expecting some major crisis. And, nothing like the shocks that we've been through in the last 30 years that were really material.
Yeah, James, it's Alex. We're trying to understand sort of as we come out of COVID, what a normal environment looks like. As you look at your business.
I hope you figured that out for us.
Yeah, no, I have not. That's why I'm asking you. What kind of market share, what kind of business do you become when we quote unquote normalize?
It's very interesting. The last 15 years, the very large global US investment banks have gained share. And the scale economics you need and the technology you need to drive these global businesses is so expensive and so intense. It's a real moat around. So I think the scale economics have accrued to those who were prepared to invest in their businesses and got bigger. Same with wealth management. I mean, wealth and asset management, Alex, we're managing, nearly $6.5 trillion. Somebody can go out and hire a financial advisor here or there or pick up a good relationship, whatever. But $6.5 trillion compounding is a massive number. So I see our future as this combination of the balance of the speed of the investment bank with the balance that wealth and asset management give us, but both really scale businesses, both, number 1 or 2 or 3 in each of their categories around the world. wealth and asset management combined and institutional combined.
James, good morning. It's Guy in London. All I hear about over here is that the portfolio managers are either looking to be paid more or looking to hire people at higher wages. I'm assuming that you're seeing the same thing over there. What is that going to do ultimately to costs going forward, though?
You know, they should be paid. They should be paid well if they've done well, and you know, ours have done phenomenally. So I'm not surprised you're hearing it. It's just a consequence. You got revenues up. Obviously, they're ringing the bell. They're bringing the client business in. They're serving their clients exceptionally. Portfolio is performing well. I would expect the portfolio managers to do well. On rising costs for the industry, I mean, we're in a talent-driven organization, and you know, we're going to do revenues this year. We're pro forma around 60 billion. So we have enormous capacity around the compensation pools to absorb rising costs for the young kids coming in and so on. That's why we made some adjustments, Guy. I don't see that. That's not a material threat for an organization like ours.
Yeah, and how long does it continue for? You had mentioned that this is not actually just in investment banking. This is also in your wealth business, attracting a lot of people. Do you see this wage pressure on the industry lasting for a while? And what is that going to do in terms of the ability to control expenses at the end of the day?
Yeah, Shanali, I really don't think it's going to be that important to what we do. I mean, this industry understands when markets are good, they're getting paid better. When they're not, they're not. You know, if you don't perform, it goes down. So I think that there are some natural sort of hedges within these kinds of businesses that the traditional companies don't have. So honestly, you know, my focus is on making sure we pay our people well for great jobs done, and they'll get paid great for doing that. That's
Okay, I guess we're gonna cut that off right there. Looks like it was probably a way off estimate that I thought of. Like, he's not wanting to have a big correction, but actually he's saying that Fed rate hikes would not result into a crisis.
Yeah, he's saying get back to normal. Let's get back to normal. Let's get this over with.
Mm-hmm.
So that's probably investor fatigue right there. We're tired of this this type of market where we don't know where we're headed.
The free money.
Just go ahead and get back to normal.
Right.
Which is an intuitive statement for somebody that's been on the market for so long, like he said.
Yeah, he's saying we're off by 10 Fed rate hikes. So I think he's thinking maybe, you know, market can at least stomach at least a couple or even more than that.
So on the other side, the other video, person being interviewed is saying that we need to slowly, you know, taper off. He's wanting a bit more of an aggressive approach, which I think they're both right. Oh, I'm being safe again. Well, I agree more with Morgan Stanley. Honestly, I agree more with him because I think this has been a long, almost 2 years. Let's go ahead and get this over with and let's get back to normal.
And yeah, cases are going down for sure. So hopefully it all goes well. Moderna just got approved for FDA third dose. So pretty soon.
For the booster.
Yeah, people will get their third dose overall, not just the Pfizer people, individuals. So yeah, before we end the show, Kuyawawi, do you have any quote for the week?
Yes. Well, let me start with the book. So I haven't shared any books lately. Okay, I haven't read this yet. I've started listening to the first chapter. The Life-Changing Magic of Tidying Up by Marie Kondo.
Oh, Marie Kondo, yes.
Yeah, this was released back in 2015.
Okay.
So she shared the story of how busy she was and having her first child and juggling her, you know, being famous and all these commitments she had. And she finally made the commitment to change her life by, you know, slowing down. And in fact, she did much better after she did that. So just want to share that book, The Life-Changing Magic of Tidying Up by Marie Kondo. And I would like to share another quote from Confucius. You know, Confucius make makes commentaries on the I Ching.
Mhm.
So I like this. Okay, so a lot of people, I think, have made some tremendous gains in the market, including companies like Morgan Stanley, right? JP
Mhm.
Morgan. They have accumulated so much wealth that I think this is good to read this this quote from Confucius. So the superior person is careful of his words and moderate in eating and drinking. Okay, so don't overdo things, okay, and be
Mhm.
careful with what you say. And then Mencius, another scholar from China, long time ago, also said, filling with food, warming with clothes, living leisurely without learning, it is a little short of animals. So to be civilized, you know, although we enjoy what we gain, we have to at least share it and also cultivate ourselves. And this is particularly from that book, right? The I Ching
Mhm.
on the number 27, providing nourishment. Okay, pay heed to providing of nourishment. When things are accumulated in great, nourishing becomes available. So when you have plenty, please nourish other people or nourish your community.
Mhm. Or give to charity.
Give to charity, which is
Right.
really, if you're investing and you want to save on taxes, this is a
Mhm.
good time to think about, charitable giving.
Right. Well, that's a timely quote because I'm in the book about Marie Kondo. I need to
Mhm,
tidy up. We're still currently undergoing remodeling. It's and
mhm.
you also mentioned Sherwin Williams. Believe it or not, Thursday morning around 7 a.m. Me and my girlfriend we were at Sherwin Williams buying some paint because we needed to have our remodeling continued or painted like all across our house. So well,
Nice.
yeah, everything is correlated, and I believe that's a timely quote as well.
Mhm,
Wowie. Sharing your blessings. In fact, sometimes I think there was a study by Pew Research
mhm.
where a certain amount of income a year, like if it's around 75,000, anything over that won't do any more changes in terms of satisfaction. It's the giving that counts in the end. Yeah,
Mhm.
very timely
It's
quote.
not the money. It's not the money.
Right. Thank you so much for that lovely quote, Wowie. And well, thank you so much again for coming on this evening. It's Saturday evening. This is the first time I think we recorded on Saturday evening, Wowie, and I appreciate your time. And listeners, that does it for this episode 21 of Mark Yu and Wowie Show. If you have any questions or just want to say hi, send us an email, markyuwowieshow@gmail.com. And remember, build that emergency savings and invest the rest for an abundant retirement. Again, this is Mark Yu signing out.
And Wawi Santos signing out.